Ari Wald is joining us from Oppenheimer. He's the head of technical analysis. Ari, great to have you on the show this morning. Thanks for joining.
Good to be here. Thanks, Oliver.
I like the title of your report. At first, it's it takes a little bit to figure out when you say bubble and sector dispersion. Walk me through what that means.
Sure. Well, we're making the case against a bubble in the overall market in absolute terms, but
okay.
Where we are seeing some excesses and what we are calling a bubble is in sector dispersion. And we're measuring this between the spread between the best performing sector over the last 12 months and the worst performing sector over the last 12 months. That reading currently stands at about 70%. It's capturing the spread between technology's 30% gain and energy's 40% decline. Now, I think this people are picking up on that idea, the fact that we've had these very concentrated market returns in tech. But I think that it's our takeaway, which is a little bit more differentiated. We're making the case that it's not being inflated by the strength and growth in technology that we've seen, which seems to be consensus view. We think it's instead be inflated by the weakness in value, that's more significant and kind of exemplifies underlying market conditions. We've been in a very difficult 2-year period dating back to 2018 when a lot of stocks are still negative over that period. Yeah.
I love this.
So I think it's bullish for the market.
I love this because it fits right into what we've been tracking here for the better part of a month, which has been this kind of divide, as you describe it, within the market, and this back and forth with leadership as the NASDAQ has slowed just a little bit. It looks like some of this other stuff wants to break out. It just can't with any real sustaining leadership. But I think what's important about this chart, if we bring it back up again, guys, is that there's been a lot of periods where people have talked about the rotation for value and the comeback. But really this puts into perspective, because this is not factors, growth versus value. This is just classic sector dispersion between the best and the worst. And it's never been here until you go back a decade, right? So this is a particularly interesting moment.
It is. And that's the extreme that we're seeing. It's not necessarily in the market, it's what's happening underneath the surface. And it remains this lingering concern. I mean, the general view is that this is a concern for the market, that it's been so concentrated. Our take, Oliver, is actually that internals are basing rather than topping. And the case is, and what we're saying is that it's actually consistent with what you would see 4 months after a major market bottom that we saw in March. And if you look at some of those recovery areas, the areas that we say are really driving it, it's being driven by financial and energy and world equities and small caps. We think they're in the process of basing. There might be some more work to do over the near term as we hit these seasonal headwinds, but I think one by one, you're going to see those areas starting to break higher, and you're going to see much broader participation, and with that, a sustainable bull market.
I want to come back to some of the dispersion the charts in a moment, but you mentioned seasonality, so let's go there real quick as we begin the month of August. Tell me what your data shows on what we should expect in terms of the time of year.
Sure. Seasonals for us, it's secondary confirmation. We're not making any high conviction calls based on seasonals alone.
Okay.
If we're expecting weakness, this is the time to expect it. May, September, 2 of the poor performing months of the year. Regardless of how the trend is, we overlay trend with our seasonals, whether the index is starting the month above or below its 200-day average. Even when you're above the 200-day, August typically a poor performing period for the S&P, but we're bullish here. So it's really just curbing our near-term expectations, but we don't want to take our focus off the puck here. We think we're recommending our clients to be patient, give it some flexibility, because we think this market grind higher continues through the balance of the year.
Okay, so the seasonality, not exactly the best, but secondary to the other trends and potential trends that you're discussing here for basically rotation is one way to put it, not to oversimplify. But when you look at the momentum spread, something similar there too, high momentum versus low momentum. You got a chart here that also you got to go back to 2015, and as we were coming out of also a period of a pretty great volatility, maybe not so much in retrospect, but at the time it sure felt like it.
That's right, and this really kind of captures the proxy for what we do. You know, we say we're momentum investors that overlay technical analysis. In general, we're recommending high momentum stocks, which are stocks that have outperformed over a prior 12-month period, and it's been a good market for momentum. Now, that usually holds for the long term. No style of investing always works, whether it's growth, value, or momentum, but through various market cycles, momentum has tended to outperform. You're looking at a century of market data, and it's working right now here. So for us, it's about staying the course, stick with what's working, owning leadership, relative strength, technology, healthcare, and then sprinkling in some of the more cyclical beta ideas. And generally, our best ideas are where growth and beta overlap, and semiconductors in particular really stand out. If you were to get a little bit of a rotation into the beaten up low momentum areas, I think semiconductors offer a nice hedge. I think it comes on the upside, and I think semiconductors hold up in that type of market tape.
So interesting, Ari. This is something we've been talking about on some of the earnings too, because semis are in this interesting spot because on the one hand, when you say your momentum and you like to follow the momentum, but also a hint that the potential basing for some of the underperforming groups are what could lift. There's a little bit of conflict there, and I just want to kind of highlight this to the viewers because what you're saying is you can find this kind of in between where chips have had momentum, but basically what you're saying is they also have these kind of cyclical, economically sensitive ties as well that could overlap them with some of the other basing parts of the market that do need the economy to pick up, right? Because those are like energy, industrials.
That's right. And if you were to actually look back through market history, we've counted about 22 major market bottoms since 1932. 6 months later, technology has outperformed more than any other sector over that stretch. So tech is an early cycle play. It's not necessarily going to get left behind. Granted, energy financials do have more beta there. If you were to get that type of lift, they can move quickly. Kind of how we've been framing it, it's going to be this swing trading between cyclical beta and high dividend defenses around what is still a long-term underlying bid for growth. So I think against that backdrop, if you were to get rotation, we'd be most worried about being in your bond proxies, your defensive areas, utilities, REITs would fall into that, telecom. I think tech has really shown some very nice all-weather leadership in recent years, and I think that continues for the long term.
Interesting. So the semiconductor is one way to play this. The other part to kind of maybe try and push back on the thesis a little bit for those that are hearing energy, I mean, you got to have so much work, right? I mean, when you've got tech as heavy as it is, you can't just have energy turn around, which is like 4% of the S&P now. I don't even know what it's at, if it's maybe even less, but it's small. You got to get other stuff to work, right? I mean, what other sectors? The banks just can't, apparently have to wait for the yield curve to expand. I mean, what are kind of going to be the signals, Ari, to where you'll go, okay, now this thing really looks like it's taking shape?
Yeah, and we highlight that in the report. Energy is really only 2.6% of the S&P 500. Wow. Does it really even matter that they're down as much as they are? And we flag that financials are going to be the much more important sector. I would say small caps as well, broadly speaking, for breadth. We did see a nice little breakout in small caps yesterday. And now we have to see financials start to work. They're the biggest component of the value index. We're kind of how we see it. We're making the case that they're basing. They overshot to the downside. They've had this extremely difficult 2-year period, probably due for some relief to the upside. And that is that's the trade. We're really only calling it a trade because it's difficult to make the case that interest rates, which have been such a big factor for that sector, are going to move sustainably and much meaningfully higher. That forgetting about the 30-year downtrend in rates and the fresh drop this year on the COVID collapse, you still have the Fed signaling that they're going to keep rates low for an extended duration of period. So yeah, for those reasons, it's difficult to make the case for financials for the long term, and with that, value for the long term.
Yeah, well said. Really interesting stuff here. And then just to expand on the banking point, we just brought up the chart of KBE, which is one you're watching here for specifically the banks. As you mentioned, the small caps. We've been watching a lot of the regionals too. Do you see any potential here that the trend is turning? I mean, they've been trying to at least, tourniquet the relative weakness next to the market, but does that mean strength yet?
Not yet. They really just have stopped going down. So that's a start. But if one great proxy for trend is the slope of a security or this index's 200-day average, still sloped lower. What we'd like to see is that 200-day at least start to slope sideways. October 2019 was the last time that happened. Of course, that turn was short-lived ahead of the Q1 COVID downturn. So we're not there yet. This is why, kind of how we see it, these recovery areas still need more time. We still need to see that base building, and it's too early to give the all clear.
Okay. Ari, great stuff. Thanks for bringing it to us. Really good analysis.
Good to see you, Oliver. Take care.
Appreciate it. Ari Wald, head of technical analysis at Oppenheimer.